Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Friday, November 4, 2022. Hope you're all having a great week. Back to update you on the markets and the economy. We had some Federal Reserve news this week after their much anticipated press conference. We heard once again from the Fed Chair Jay Powell, some of his comments on monetary policy. So let's break it down. Let's talk about what we see and where we are likely to go. So the big news, as we discussed, was Wednesday's press conference. It was widely anticipated the Federal Reserve was going to raise interest rates by 0.75%, which they did. But what market participants were looking for more was what was the Fed going to say in their statement? Would there be some hints at them easing up on policy, a pause, a pivot, whatever you want to call it? And that is what the market was looking for. And that is what the market got. Now, just to break down the timeline of events for you so you know how these Fed days work. Every time there's a Fed day, it falls on Wednesday, and they give a press release or they give their minutes from their meeting at 2 p.m. And then 30 minutes later, Jay Powell takes the podium for a press conference, questions, answers at 2:30, right? So we tend to see a lot of volatility both at 2 p.m. at the release and then, of course, 2:30 and onward based on what Jay Powell says and what questions he's asked. So the initial release was seen as favorable to the market. The Fed talked about doing the 75 basis point hike in November and then considering a smaller one for December, pausing to reassess the impacts, right? And that's something we've been really vocal about is they need to pause to reassess the impact because monetary policy is something that lags. It takes a while for it to filter through the economic system. So the Fed needs to sit back and see how this economy is going to behave with 7.5% mortgage rates and the like. So that's what the press release said. Fast forward to 2:30, Jay Powell starts his press conference, gives a little kind of primer on what the Fed statement was, and then opens up to Q&A. And it was at that point, when he opened up to Q&A, the market had started to move lower. Okay, let me just go into the week here. So here is Wednesday, right? Here is our Fed day. We were pretty much flat into it. And the minutes come out, right? And let me break this down a little bit more. Okay, so the Fed minutes come out, and the press release is liked by the market. Market starts to move up. And then it was at this point the market started to get a little soft, right? Because it's got to kind of wait and see what's Jay Powell going to say. Jay starts speaking, the market moves a little lower. And a reporter asks him a question. Now, at the moment, and this is important for context, the market is down, but the reporter falsely or maybe unknowingly asks Jay Powell a question, says, Chair Powell, the markets are reacting positively to your press conference. To what do you say to that, right? And it was at that point Jay Powell decided to break away from the press release that the committee decided on 30 minutes prior and basically read off a greatest hits list of hawkish comments about why stocks need to go lower. And naturally, that is exactly what they did, right? So this is a 5-day view. We moved up, we moved down. That's where we closed the day. And we traded lower yesterday as well until we got a little bit of a rally today. Today was quite the day for volatility, right? Markets opened higher, they went lower, they went higher, they went lower, and we finished back higher, okay? So when we zoom out, markets are still doing a decent job of defending the lows here, but with a little bit of pullback. But the bigger story this week is the Fed, right? So why did the Fed craft this beautifully written press release only for Jay Powell to crumple it up and throw it over his shoulder 30 minutes later? And a lot of people in the media are really asking the same question. So it remains to be seen. I think you'll see, it's starting today a little bit, some Fed speakers on that very same committee coming out and walking back Jay Powell's very hawkish comments, probably pretty annoyed that they put 2 days into drafting a press release and then Jay decided to go in another direction. But that'll be a conversation for next week, and we'll have to see how things develop. So again, looking at the markets, right? Markets, trying to rally off the lows, defend the lows. It's been a pretty mixed earnings season. Markets acted rather favorably because of that, but we want to see if the market, moving up next week, obviously midterms on Tuesday, that's going to be a big market mover, big volatility event. Depending on the outcomes, will give us an idea of where the market goes next. Now, wanted to share a couple pieces of data here, some charts compiled. So this one, a couple of these from our friends at Apollo Management, do great research over there. So this what we're looking at is the different central banks around the world, right? How far they've come and how much further they potentially have to go in this rate hiking process. And if we look at, we have the Fed, we have the Bank of England, we have the European Central Bank, and then we have the BOJ, which is Bank of Japan. the U.S. Fed has come the furthest and is the closest to done, right? So basically what we're looking at here, our current policy rate is the blue shaded portion of this bar graph, and the expectations by the market is that the Fed is going to go a little bit higher and fill out the rest of this bar chart, right? So the Fed in the U.S. is almost there. Bank of England has made some progress. They have a little further to go. ECB, it's about a 50-50 proposition, halfway home. And the BOJ really hasn't had to do very much because their inflation is much more lower, not as broad-based as what we're seeing in the rest of the world. So they really don't have too much to do, but they haven't done that much heavy lifting as well. We're also seeing the probabilities of recession rising, right? So again, Canada, European Union, US, UK, right? Really, Canada, for some reason, is the only one that's not showing a higher degree of recession probability. Not sure what that's all about because I think their economy is very sensitive. But we're seeing the EU, the US, and the UK have rising odds of a recession. Now, we would argue that the recession is already upon us, right, based upon economic data that's been in place for a long time. But the consumer is still strong, so it's not your typical recession. But this is something the Fed's going to pay attention to. And naturally, if we get in a recession or we get close to one, in their view, they're going to have to alter monetary policy. So that's something to keep an eye on as well. Not rooting for a recession, but it's these type of indicators, right? Like we saw in 2020, same thing. Odds of a recession spike. The Fed has to ease monetary policy. And then the last thing, this is from Europe, but it's basically the same story, kind of the world over. Inflation is largely attributed to energy, folks, right? So on this chart here, and this is just the Eurozone, but it looks very similar in the US, the green line is energy pricing. The green line is the consumer price index, inflation, and the blue line is energy prices, right? So inflation tends to follow energy prices almost in lockstep, and we saw energy prices explode higher, right? Inflation exploded higher, and now energy prices have really come back down to European areas and European unions, and we would expect, right, if algorithm is going to hold true, or this analog, I should say, is going to hold true, then inflation in the Eurozone is going to come down as well. Now, why are we talking about the Eurozone? Because the whole world's in this together, and until we get global inflation down, no one particular nation is going to be able to come out, shiny on the other side. So when we look back at the week in review, again, we really didn't cover a lot of ground. We did a lot of chopping in between. The market posts a slight loss this week after 4 consecutive weeks of gain. But now all eyes will be on next week's midterm elections on Tuesday, and where the makeup of the Senate and the House will very much determine what economic and tax policy looks like or could look like over the next 2 years, and the market will be watching that very closely. So if you have any questions, feel free to reach out to us. Always here to talk to you about anything that's on your mind. We hope you have a great day and a great weekend, and we'll see you back next week for the Heritage Market Update.